This year might just be the right year to invest in property. But before you jump in, do you have a low-rate investment loan pre-approved? It might be the right time to invest, but the wrong loan could dent your prospects for achieving the maximum return. Are you armed with the best finance at the sharpest rate? Find out with Finny. Call us now on 1300 002 023 and find out what you could save. Or visit our website, finny.com.au to book an appointment.
This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? Phil Tarrant, host of the Smart Property Investment Show. Hope you're well. Enjoy coming into the studio to chat through property. I get a real kick out of it, and been at it for a little while now. And for those of you that know me, you probably know I'm wired a particular way, and I'm not the most reflective of people, but it's nice to get good, positive feedback about what we've been doing on the Smart Property Investment Show for many years. I was only just last week eating a steak at a restaurant, and a gentleman come up and sort of mentioned he listened to the show and how it had absolutely shaped his attitudes towards property and set him down a pathway of investing in property and transformed his family's life in creating wealth. And I don't really give too much thought about it. I just enjoy coming on, having a chat with property investors and property professionals. And I know this person tunes in the phone. I won't use tunes in the podcast, won't use their name, but they know who they are. I got a real kick out of it. It was really nice too, because, I talk a lot. Nearly 250,000 people listen to this Property Investment Podcast Network every month, and I see the emails coming through, but it's nice to get personal feedback that what we're doing is actually changing, shaping opinions, approaches, attitudes, sentiments, thoughts towards property investment, and people are actually taking action. So it's really, really cool. I get it. So thanks for coming up and saying g'day, you know who you are. And you sort of I get a lot more of it now, which is interesting because of just the breadth of this show. But everyone's feedback is noted. We appreciate it. We like doing what we do. And it's nice to be able to make a difference with how people go about investing in property. And, we come at it from a particular angle. We talk about it. I share my views, my opinions on it. I'm a journalist. I'm not a property expert, on a property professional, but I've been around it long enough to probably provide an opinion or be able to sort of break it down so something I can understand. And I guess my skill set's probably doing that and then communicating that so other people can understand it, because people do get confused about property and property investment. So if we can democratize it, make it more accessible to people, that's a good thing. There's people that work in property who do this every single day, and no doubt they have the same outcomes of the work that they do. They help people down this pathway of investing in property. And why do most people invest in property? Well, most people want to make money out of it. There's still some people that go, I love property and I love doing it. But realistically, you scratch the surface, you work out pretty quickly that people want to make a few bucks. So at a point in time when they don't want to work, they don't need to be relying on the government for a pension, and they can maintain close to the lifestyle they had when they were working. And that's what most people's sort of goal is. And they use property strategists. I get them on the podcast all the time. Someone that's been coming on the show for many years, for as long as we've been recording this, is Steve Waters from the Right Property Group. He joins me today in the studio. We're going to go around the grounds and talk about what's happening in property and just get some sense for the market we're in. But Steve, you must get it, but differently, right? People come to you and say, hey, we want to do this. Can you help us out? And you help them out. But, I don't know how many umpteen hundreds or thousands of people you've probably put down the pathway of property investment, but you still get as satisfied with the outcome for people as what you did in the early days?
Yeah, it's an interesting question. When I first started, there was probably only 5 of us in Australia. So we're going back many, many moons ago. Today's clearly a different environment, and I think that's healthy because the industry has now been exposed, for want of a better word, on what is possible. I still get a kick out of it. I love the hunt. I love the transaction, I guess. And I love putting together all the different data points and overlaying that ground truth component, as we've talked about in the past, to then execute. It's fun. Like, I guess a different way to look at it, like I've got the coolest job in the world. I'm sure of it. Like, I get to hang out, collaborate, speak with, interact with the doers of this world, the very small percentile of people that do.
Yeah. A lot of people think about it. Not many people do it, because everyone talks about property. Like everyone talks about property. They're either lamenting about not being able to find a rental versus I can't buy an investment property because it's too expensive versus I want to build my dream home and raise a family in it. Like it is something which is intrinsically connected with the Australian way of being.
Well, it's even above that. It's the entrepreneurial spirit. People want to better themselves, and it takes a very unique person to do that. And the percentages show that it is very unique, even if it's just this asset class. Once again, it's like, I'm chuffed. I'm honored to be able to speak and interact with these people. It's great.
Yeah. And you must have some clients that you've sort of steered down a pathway from zero to many, many properties and creating significant wealth, right? Do they change over time, do you think? The people that come into you as their first sort of investment versus, they have tens of millions of dollars and multiple assets.
Without fail. Yeah,
they change.
I'd say they change, but also you could get a little bit more micro with it, and even industry specific, or what their jobs are.
Yeah.
Also have or can dictate the type of investor they are. And I often reference engineers of any type who they're wired a certain way and they think in a certain process. And my experience has shown me that when they first start, they're probably their biggest hurdle because it isn't laid out flat for them. But once they get out of their own way, they become some of the most successful investors because they are methodical, they are strategic. It's interesting.
You like working with engineers, or you'd rather sort of but humble property podcast hosts trying to make a few bucks out of property?
Well, yeah, it's always good to deal with a journalist, Phil.
Yeah. I make most people edgy, but anyway, it's good. It's nice. It's good to see people doing good stuff, and if you played a small role, albeit in your different way of doing that, that's a cool thing. So keep at it, everyone. Keep doing it. And we do a lot of investor stories on this podcast just to show that it can be done. I talk about my own journey investing in property and other people. The funny thing is, Steve, and I was at a financial services function the other week. I get around a fair bit, and it was I don't know how familiar you are with this, but this was before the release of this quality of advice review, which was sort of it's stewarded by Michelle Levy. She was a lawyer out of Clayton Utz by memory, one of the big legal firms. But she was tasked by the government to go away and look at this idea of advice, right? The quality of advice. The financial planning, financial advice sector has gone through rapid changes over the last decade. The way in which they got paid changed. The way in which they could offer advice changed. The red tape, the bureaucratic rigmarole, if you want to call it from a better word of offering advice, change, become very onerous, very tough. And one of the outcomes of that is less Australians were getting advice, right? But a lot of the advice and the concept of advice, and so they spoke about it, this function I was at, is very much towards sort of managed funds and superannuation, and where Aussies are investing their money outside of property, and the conversation come around, well, the quality of advice is a bit of a black hole because it's sort of focused on a collection of asset classes, whereas most Australians keep and grow their wealth through property. But it just sort of remains outside of this notion of advice. And I know this report's now been handed down, and I can't remember, there's 20 recommendations or 22 recommendations, whatever, and it's outside the scope of this chat today. But it got me thinking about advice around property. This is where most Australians should be getting advice, but it's very, very dangerous grounds to be offering advice around property. I know property strategists, buyers agents, your cohort. It's very difficult now to still be recognised for being an advice practitioner around property because it's a bit grey still.
It's very grey.
But that's where the advice really needs to take place. Like, more Australians would benefit from getting advice around what to do with property than, advice around superannuation. Not to say that they shouldn't be getting advice around superannuation, but super funds can't provide advice. And I think one of the recommendations is changing potentially limited advice in super funds. But put it down, like everyone talks about, if you've got a superannuation balance of a couple of hundred of thousands of dollars when you reach retirement, I don't know what the number is now, how much you need, but I tell you what, more people have a crap load more assets inside of their property than what they do their super fund at the point of retirement, but they're not getting any advice around it. Getting a bit low boxy at the moment.
It's certainly a grey area in and around that advice model. The more onerous via red tape, the more expensive it is. And that's why a lot of people aren't getting the financial advice, because it's just too expensive. And it's potentially an outdated model to some degree. But you're right, the biggest asset anyone owns is their home, whether it is where they live, whether it's an investment property, and they carry that forever or for as long as they can. And in our space, because it is unregulated, there is some, what I would call some dubious advice out there. But there's also a very big difference between a property investment advisor and a buyer's agent and a real estate agent and your brother-in-law at the barbecue. So, choose wisely and always do your own diligence and educate yourself, I would suggest.
Yeah, and to the point, I think people that tune into this podcast are looking to be proactive around wealth creation. So they're not going to be relying on other people for a comfortable retirement. But it gets very, very complicated. And if you haven't looked into this at all, if you've got elderly parents who have housing and asset, which is unencumbered with debt, it's very, very difficult. You might have a house to live in, but the value of that house will determine whether or not they get any government assistance at the point of retirement. And it gets very, very complicated, very complicated. So get stuck in early as a property investor, manufacture your own outcome. So you're not relying on the government, and I'm sure the government will be happy me saying this, so they're not relying on the government for a healthy retirement. And guess what? You don't want to be beholden to anyone other than yourself. So you don't want to be sitting there waiting every fortnight for a check from the government so you can go and buy your food and have enough money to go and play bingo, right? I generalize. But, this is the reason why people invest in property, Steve, because they want to do that.
I think it's a good point. I think you should never outsource responsibility. Ultimately, you're the one that's responsible. And I think too many people play it safe, overly safe their whole life to retire and die.
Yeah.
And when I say overly safe, it doesn't mean that you need to speculate, gamble. Everything has a risk attached to it. But I guess with today's technology, as we've spoken about many a time, people have the ability to be educated, whereas 20, 30 years ago, they didn't. So take some responsibility is what I would suggest.
Take responsibility, and you're tuning into this, and therefore that's a good thing. And we're here to talk about property. So, Steve, we're covering a lot on this show. We had a good yarn the other day in relation to on the Investing Insights Right Property Group podcast we do together. And what are the indicators that market's going to start changing and start going from a softening market to a strengthening market? I don't want to go over old ground, but while we're having that yarn, I was sort of thinking, I wonder what's going on in different parts of Australia. There is this sort of misnomer that property is not going up in Australia. It is in some locations. So, embrace that, get on with it. There's other areas where prices are in decline. Are we at the bottom yet? What is the bottom? Where is the bottom? Horses, of course, depending on the market. But I want to get a sense for what's happening in a different capital city, Steve, but also in rural markets. And let's start there. Rural/regional versus metropolitan. And for me, let's, break this down really simply. Metropolitan markets in New South Wales are Sydney, Newcastle, maybe Wollongong. Everything else is rural or regional property. So using that as a sort of framework, and the same applies in other parts of the nation. In Melbourne, for example, I'd classify Melbourne as metropolitan. You're probably, I don't know, would you say Geelong is metropolitan?
Well, it's an interesting point because I think regional is in the eye of the beholder, in particular that state. So you mentioned Geelong, they would classify that as regional, but for us, it's not. It's like our Central Coast, which is an hour, let's call it, away from Sydney. So I think we need to be careful on what we're referring to in terms of regional. But to answer the question, the regional areas throughout the country are all performing quite differently now. During COVID, we all know there was that, I guess, the exodus from metropolitan areas to a lot of these regional areas. And to be, I guess, accurate, we could then segment major regional areas into the small satellite towns that surround it, that don't have the populace or the economy drivers or what have you. And there was a lot of people that exited the metropolis areas to some of these smaller regional areas, and they did very well, whether you were an investor or whether you're a homeowner. However, in some parts of the country now, we're starting to see a retraction of populace back to the metropolis, or the commutable distances, I guess, to metropolis, which is a very important point. And you could almost include holiday homes in some of those regional areas as well. So there has been price slippage. We've seen vacancy rates increase. We've seen stock on market increase. And I'm being quite general. There are still some very strong areas regionally throughout the country, but there are also some that I would put into the basket of beginning to suffer. And I guess the question is, well, why? And whilst the flow of credit was free flowing and very cheap money, people were quite optimistic and comfortable with buying, say, a holiday home in a long way away area. But as the economy has tightened up, rates are up, as we all know, cost of living is starting to bite. Well, some people are making the decision on which asset should I dispose of. And more often than not, it'll probably be those ones that maybe some would argue weren't the most sound decision to begin with.
Yeah.
And it was more about a moment in time rather than longevity. Now, having said that, once again, there are some regional areas, especially in the Queensland vicinity, that are doing extremely well, still growing, still nothing to rent. So as an investor, your rents are increasing. If you're a tenant, you're struggling to find accommodation. And also the overarching element of affordability as well starts to kick in. So those that are investing in the strong areas, the strong regional areas, have the ability to do so because there's a lower mortgage attached to it, as opposed to postcode 2,000, 3,000, 4,000 and the like, and better returns, some would argue.
Yeah. And we spoke about this, and it was quite a point of discussion through that COVID period when this exodus happened. Everyone's sort of chasing lifestyle opportunities, whether they were Sydney-siders or in Melbourne or in Brizzy, let's just talk for simplicity, the East Coast. Our point then, as it was and is still today, was, and I still subscribe to this, is those regional locations which are in absolute striking distance of capital cities will perform differently than those regional locations which are more holiday orientated.
Right.
For a lot of professional people, working a hybrid environment has become the norm. Like you're in the office 3 days a week, maybe at home 2 days a week, right? So you need to be able to have seamless facilitation for access to the capital cities. Hence the reason why you see locations like Wollongong or the Central Coast in New South Wales. You see the same in Brisbane, and you certainly see it in Melbourne as well. The Mornington Peninsula that's really exploded. You look at properties down through Portsea and that sort of area, that facilitates that lifestyle equation for people, and they're still holding really, really strong, those areas. When you look at other areas sort of at a regional level, which are further away, Byron Bay, for example, those markets are certainly starting to change. And I think there's people that fall into that boat you spoke about, where was it exactly the most practical decision at that point in time? Now you're getting called back to the office more often to live that far away. It's tough.
I think there's a big distinction between a blended work environment, so call it 3 days at home, 2 days in the office, versus never have to go to the office again and work from home for the rest of your life. And you and I have had that discussion over the years now in and around COVID, and we ask ourselves, is that reality forever? The blended work environment, I personally feel, is here to stay, right, for many, many years. And as a result of that, different markets are performing accordingly. So if, once again, to use my example, if you're out in the middle of Australia because you thought you were going to work from home for the rest of your life and now you can't because the employer has asked you to be blended, as an example, well, then you have a decision to make. And overlay the cost of living, of course, and people are starting to chase the higher paying jobs to help with the cost of living. And that's not in the middle of Australia, generally speaking. It is towards metropolis, where big businesses.
You need to be tethered some way to some sort of corporate location. And it might have been easy when employment rates were so low. That's starting to change. You'll see that change further as economic conditions evolve, and you start seeing migration coming in. Like all these things will change. We've been through a period of the lowest interest rates in history and really low employment. Anyone that wanted a job had a job, and there was positive pressure for people to the balance of power, if you want to put it in a certain way, was in the hands of the employee, whereas that is now starting to shift a little bit, or it has shifted, where the balance of power is in a more normalized environment. I wouldn't say it's in the hands of the employer, but it's more normal. It's a lot more of a pragmatic environment where the demands of employees and the fact that companies wanted to keep them employed, there was a little bit of grey in how they operate, a little bit of flexibility, but that's starting to change. Some of the banks are saying, get in the office. You see Elon Musk over in the US pretty much going to when he bought Twitter, and SpaceX go, if you want a job, you're in an office. If you don't want a job, you stay at home. Or they're saying, hey, if you want to live in the middle of nowhere, you're not going to get a San Francisco salary. I'm going to give you the salary of someone living in Idaho, right? So this is the way it's all working now.
Idaho. Idaho. Reminds me of a movie. But I think that's a very fair point. And whether that evolves into the same scenario here. If you live in the middle of Australia, the wage is accordingly adjusted or whatever it may be. I don't know. But when we look at those regional areas, just coming back to that, what we can see is, which is quite interesting, is that the higher the income bracket of the person that has purchased that particular property, so therefore the area and the mortgage attached to it, is probably performing better than those ones at the extreme opposite end of the scale in terms of, a $40,000 house in, Nowhereville. And I think that trend will somewhat continue.
So your point then, and we're talking about probably markets across Australia, it's still worth considering non-metropolitan locations.
Yeah, absolutely. Absolutely.
What do you look for? What do you look for? What we've just really spoken about.
Well, I'm looking for multiple economy drivers is a must. So we're talking about jobs creation, continuation of jobs, macro, micro effects of that to the economy to keep people there, because the more they earn, the more comfortable they feel, the more they're going to spend on the asset, which then, with a myriad of other factors, increases the asset value. And it's also its proximity to good transport.
Yeah, key.
Is a key, because if you take the Sunshine Coast as an example, where its population has exploded during COVID for what I believe is all the right reasons. Great lifestyle. There was an element of affordability back then, great infrastructure, the airport. And I would probably argue that it's a higher income bracket people that have moved there, yet their ability to be able to access transport, whether that be the freeway, whether it be the airport, to go back to the office environment should they need to in that blended approach.
Traffic's through the roof.
But they're throwing infrastructure to it, right? They still do have the effort. Gold Coast is another great example. Wollongong, Central Coast, Newcastle, great examples. Geelong, Mornington Peninsula, Bendigo, Ballarat, and the list can go on. All recipients of good economy of drivers.
They're large cities, right? Like you're talking about large economic areas, like very large economic areas.
Correct. So, and that, I guess, is the theme. Are we looking for, as an investor, or even a homeowner for that matter, are we looking at it from a long-term perspective, or are we just looking at it from a short-term ride the gravy train and hope that it lasts or gives us longevity? And I guess that's that inflection point where I guess some people have determined to themselves that they've may or may not have made the right decision.
Well, okay, there you go. So don't discount regional and rural locations as part of your investment strategy, I think was what the consensus there. But let's talk about capital city markets then. That's the 2,000 postcode Sydney, 3,000 postcode Melbourne, 4,000 postcode Brisbane, 8,000 postcode WA.
Correct.
South Australia's 8,000 as well, isn't it? South Australia, 7,000, 8,000. Adelaide, we're talking about. But let's go to a break beforehand. We'll get to that when we come back. Stay with us, back in a moment.
Are you looking to create passive income through property? Simon Liu from Housefinder has achieved over $700,000 per annum in passive income by only buying genuinely off-market, below-market value and cash flow positive houses within major capital cities. For the past 7 years after quitting his day job, he has been helping others achieve similar goals to reach financial freedom. On average, his clients achieve $80,000 plus equity extractions from the houses they find, all within 6 months of buying. Visit housefinder.com.au to find out more.
Welcome back, Phil Tarrant from Smart Property Investment. This is the Smart Property Investment Show. Listening to us on the Property Investment Podcast Network. There's a whole bunch of other shows you can listen to on this network. But here today, I'm chatting with Steve Waters from the Right Property Group. And we just spoke about regional and rural markets, but we're going to talk about capital city markets, what's going on across this great brown land. Let's kick off in the areas, probably the hottest capital that people are talking to me about right now. And sort of up until about a year ago, it was probably the least popular capital city, and doom and gloom with people sort of waiting for 10 years for property prices to get back to where they were. Are they back there? I don't know. Steve Waters, we're talking about the great city of Perth.
Correct. It did have a decade and some of nothingness, but that was on the back of what was exceptional price growth, beyond even booming, to a point where there was a moment in time where if it wasn't, it was very close to becoming Australia's most expensive city, right? More so than Melbourne and Sydney, right? And so then it's done nothing on the back end of that boom as the resources sector went a different direction and the construction of mines and therefore the need for the labour force dissipated. And nothing happened. As a consequence of that, they also built nothing, which has left them in a massively, along with the rest of Australia, undersupplied position. The interesting thing about WA, but we'll kind of stick to the Perth region, is that it has some of the highest income per capita, yet also almost one of the most affordable cities in Australia. And so that makes for a very good metric for investors, but it also makes for a very attractive scenario for people that are looking to move and create a new lifestyle with a well-paying job and a great lifestyle. And Perth offers that. As a result of that, the growth is still there. The yields are continuing to increase. In fact, for context, we had a client take ownership of a property just before Christmas, and on their first open home for rent that the property manager was facilitating, so they usually go for about half an hour to an hour. At the end of the day, he had over 33 applications. Like, it's 33 applications. Like, it's just crazy. And that was in the day. Then the applications kept coming, and it almost became an unwanted fight from potential tenants to acquire the property, because that's how short it is there. They understand how dire the situation is. So when we throw all of that into the pot, we're still quite bullish on the Perth region. However, as with all areas, it's not a throw a blanket over the whole region and invest anywhere in anything. You need to be very deliberate and very strategic
what you do
and methodical in where and what you purchase.
I was having a chat, and you know this gent, the most recent president of the Real Estate Institute of WA, Damien Collins, who lives out there, who you know him quite well. He's a good operator, and he's got this. And I'll probably get this wrong, and if I do, Damien, I apologise. But he's got this sort of, it's not a principle, but this sort of this theory saying, why are property prices in Perth the same as Adelaide, when to what you spoke about, affordability is better, is really high incomes and stuff. He goes, it should be closer to Brisbane. Like, that is the analogue of what it is. So to give some sense for how that market will perform over time. And I sort of subscribe into what he's saying. And if I butchered that, I apologise. I spoke to him about it on a podcast, but I think I've got it pretty right. That should be the analogue. Yeah,
I actually agree in a very general sense, right? Because it can be a suburb by suburb scenario, but the analogy is right. Like, why would the average price of the region be close to, if not in some cases, a little lower than some of the regional areas throughout the country? And it's a major city. It's an economic powerhouse. Some would argue that it's a little fickle, based in and around resources only, and that's not quite the truth. But you could have that same argument in and around some of the regional areas that are tied closely to agriculture, as an example. But I actually subscribe generally to what he's saying as well.
Yeah. And to the point, like beforehand, it was an analogue to Sydney, and hence the reason why it was way overvalued and priced, right? And there's a bit of a metronome that the Perth market is so, Western Australia is so intrinsically connected with the resources industry, and, this sort of surge towards, renewable, cleaner energy. There's a hotbed of stuff they can dig out of the ground there and send it out for lithium batteries and other similar stuff. Proximity to Asia is really good. There's a trading port, all that sort of stuff is all in its favour. But I don't want to go too deep into it, but consider Perth is
consider Perth. Absolutely.
Consider Perth. Okay. All right. Let's go anti-clockwise. Let's go to Adelaide.
Yeah, Adelaide's holding firm.
Yeah.
And I guess the theme with a lot of these areas throughout the country is that the value is being underpinned by the vacancy rate. And what I mean by that is lack of accommodation, and so forth, therefore rising rent. So the ability to be able to control the asset is easier than if there were no sort of amounts of increasing rent or cash flow. Yeah. So Adelaide is still holding its own. Rents are continuing to increase. But my philosophy in and around Adelaide is, as with all areas, but because we're talking about Adelaide, you need to be very careful where and what. If you're too far from the CBD, and I'm not talking you need to be a blue chip CBD investor, I'm just talking relative to the area. If you're too far out of the CBD, you could be in the middle of nowhere. Now, whilst that middle of nowhere is performing well today and has over the last couple of years, we need to be forward-facing to what the future has. So generally speaking, if you could sort of throw that 40-minute ring around the CBD, which gets you to a lot of Adelaide, where we like it.
Yeah, there's a lot of beachside type stuff. It's good, like Onkaparinga and all those areas, good transport, all of those. And that's been a steady as she goes, slow to medium burner. And that's really how you'd wrap up Adelaide, whether or not people will be annoyed with me saying that. The good thing is it's not feast and famine in Adelaide. It's steady.
It's always been the little engine that can.
Yeah.
Up until COVID, it just does that little bit all the time and it's safe. Yeah. You could have the argument saying, well, if I had an opportunity cost loss by not deploying money elsewhere. But since COVID and maybe just before COVID, probably 3 years beforehand, it was definitely good, strong green shoots. COVID perpetuated that and it's done extremely well. And even if you look at their rental growth, it's some 40% over 3 years.
It's pretty good. And the last sort of 3-4 years looked really good for Adelaide because when you look at sort of multiple drivers, the economy, obviously you've got viticulture and all that sort of stuff. You've got tourism. That's all really cool. One thing that Adelaide is well regarded and renowned for is its defence industries, and they're supposed to be building, and that they still are, I believe, the frigate program. There's a big defence strategic review happening now, whether or not they're going to build as many as they said they would do. And then the submarines, obviously, are off the table. The French we've said no to, and there's talk about sort of buying some off-the-shelf capabilities out of the US or the UK. There's a big question mark about that, whether that's going to impact sort of employment prospects and that sort of stuff. It's a bit of a turn on its head. So it's a question mark for me there.
Well, it had a couple of false starts. It lost its car industry as well, manufacturing, and they reskilled a lot of those workers for defence in terms of the frigates and the subs. The frigates are shaky. The subs are gone. Olympic Dam was sort of 3, I think it was, stops.
Yep.
And now it's off the table. But the interesting thing about South Australia, and once again, particularly Adelaide and surrounds, is if, based on the world's current circumstances, our defence spend is doubled or tripled, there's a good argument that Adelaide will be the recipient of a good chunk of that.
Well, at a sort of geostrategic level, it's a long way to Adelaide, whether it by air or by missile or by sea. So it's just a geographically strategic area for Australia. And anyway, that's outside the scope of this chat. We could probably talk all day about that, what it means for property investment. But let's have a chat about Hobart and sort of wider Tasmania. And it's sort of, I guess you could, so it's metro and rural, but you've got some big regional centres like Launceston, like Burnie, I would say, a bit smaller. But let's talk about Hobart. It's just, if you got into Tassie, if you got into Hobart at the right time, you're done pretty damn well.
Yeah, absolutely. We did a little bit down in Tassie probably 2 years before COVID, a little bit leading up to it, and then we stopped. Maybe, fact is prematurely.
Yeah, I
guess COVID perpetuated it further. But if we fast forward to today, we see greater levels of stock on market, not massively to, I guess, put blood on the streets or anything like that, but there's certainly more stock on the market. There's a little bit of supply in the pipeline as well. So there's not that, I guess, lack of supply that will continue to perpetuate the areas. I think it's still solid. I don't think there's going to be this fall from grace, so to speak. The question is that a lot of people ask, and I don't know if anyone's really got the answers, is has it done its thing now, and will Tassie have a decade of nothingness?
Which is a little potential.
With a bit of history repeating itself. Yeah. But I think if you've done well, if you purchased at the right time, you've done extremely well. But as always, it's what have you done with the equity position? That's important.
Yeah, true. And I want to do a run up the East Coast, but before we do that, let's talk about the Northern Territory. Let's talk about Darwin, and I'd probably sort of factor in. Is it Palmerston North? Did I get that right? Which is bigger than Darwin CBD. So let's just add those two together. I was up in Darwin this time last year, having a nose around, getting a sense for things, which was good from a much like you, Steve, ground truth, actually getting on the ground and having a look at the ports, having a look at the setup of the city, having a look at the capabilities of the town. Obviously, really intrinsically linked with the national security of Australia. There's marine rotations going in and out of there. There's the apparatus that supports the defence force up there. It's a defence town in many ways, and that sort of has a connectivity with property prices. Some pretty good developments up there. So it's a livable place. It's hot if you're okay with it. But for property investment, Steve, I know it had a bit of a run for a while recently.
Yeah, look, it's done okay. The question is, has it done as well as other areas during the same time frame? And the short answer to that would be no. Yields are very strong. Same thing, undersupplied. The cost to operate up there is a little higher. So for those that are entertaining investing in the Northern Territory or Darwin and its surrounds, you really crunch the numbers. Things like insurance, property management, repairs and maintenance is all more expensive. And as I mentioned, it starts to erode the cash position. So the net is perhaps not as attractive. The interesting thing about, I guess, that neck of the woods is a little bit the same as Adelaide if we're looking forward to what defence will do, because it is closely tied to that. And, the big imagine is if the defence spend is tripled, making a sort of number up, it, like Adelaide, will be the recipient of a lot of that. And that's great stimulus for the economy, whether that be via the apparatus and the infrastructure, whether that be via more overseas sort of ins and outs. That all pumps money into the economy, which then self-perpetuates, and there's a necessity for accommodation and industry to support it, etc. But for me at this point in time, because I am more conservative than others, it's a bit of a watch and see.
Yeah, and a lot of it is, again, dependent on the security environment and defence spending. You won't see a tripling of defence budget coming out of the Defence Strategic Review, but I think there'll be a continued focus on defence spending and securing our borders, considering the geopolitics, geostrategic location of the region, and get yourself a high school atlas and look where Darwin is, and you see its proximity to Asia, and where potentially there's a lot of people talking about potential conflict in Asia as a result of contention around Taiwan. I'll tell you what, Darwin's not too far away. So it is defence spending. If you think of this really simply, defence industry, if it happens, Adelaide, the deployment of defence assets, as in people in uniforms, is more Darwin. So anyway, it's topical. And that sort of comes down also through to places like Townsville. We might as well go, let's do a rundown. We'll do a rundown the East Coast. So we'll go to a break, last break.
Would you like the latest news and insights in HR, leadership and people management? HR Leader has you covered. Subscribe at hrleader.com.au.
Welcome back, Phil Tarrant from Smart Property Investment with Steve Waters. Now, let's talk about Brizzy, but connecting in with our chat just before, following the money, really. Following the money, following the people, following the assets, following the spend. Townsville, Cairns, those regional areas of Queensland probably fit within that bucket, what we spoke about the front of this podcast around good regional locations, which are worth considering. But Brizzy, everyone gets obsessed by the games, Olympic Games coming up there as the panacea for all things positive around property. I don't know whether you subscribe to that, Steve.
No, not at all. I don't. I think I think I've referred to it in the past as it'll be a great branding exercise on the worldwide stage for Brisbane. Not a lot of people from overseas understand Brisbane, let alone know it. They know Sydney, Melbourne, maybe the Whitsundays, but not Brisbane. And I think it'll be a great opportunity for Brizzy to be on the worldwide stage. The infrastructure spend beforehand does contribute to the overall picture. It just depends on what infrastructure. So if they're going to build an equestrian centre in Dalby, it may not have won't have the long-lasting effects to the economy as opposed to rail, road, things closer to the CBD and its surrounds. So do we pin our hat on the Olympics? No. Is it a small piece of the puzzle? I believe so. Brisbane, contrary to what the general media is talking about record price drops, is actually dependent on the property type and its locality. And what I'm referring to there is, and I'm being quite general, but it's what we're seeing, is that if you took the middle of the pandemic and prices were growing at a rate of knots in Brisbane, you could have had a 3-bedroom house that was barely habitable underneath high-tension power lines and literally goes underwater and major flood events, and you could have put whatever price you wanted onto it and you would have sold it at the higher price. People would have fought all over it. You fast forward to today and that's just not what is happening. And so those types of properties aren't selling and they're free-falling because they have warts on them. And they should have never have attracted those prices, but that's what FOMO does, I guess. So it's distorting the data a little bit. Now, has it softened somewhat? Absolutely it has. But when we look at where its patterns are, it's fallen just nicely into where it should be. The one thing that, well, not one thing, but a major thing that Brisbane and its surrounds, so you could throw in sort of Bundy, Sunshine Coast, Gold Coast, go even further north, Bundy, Townsville, Rocky and the likes, even out to Toowoomba, which is regional, and they literally have nothing for rent. Like it is astonishing the lack of housing that is available, roofs on heads. And as I say that, I'm thinking back to the state government's retraction in and around the land tax scenario, which just would have exasperated the problem. But,
well, we fixed that. Don't worry about it.
Yeah.
Don't worry. Phil sorted that out.
Yeah. Thanks, Phil.
Yeah. No,
that's why you get people. That's why you get people come up to you on the street.
Yeah. I don't think they'll let me back in Queensland, but
as you're eating your steak Salt Bay style. But so they've got a real issue there, which I was going to say soon, but I think it already is a real social issue. And there's not enough being done to rectify that lack of accommodation. And as a consequence of that, rents are skyrocketing. Now, as with all areas, well, I guess they're experiencing the same thing, but there will become a point in time where there is a natural ceiling in and around affordability of that rental growth and what someone can pay for the property. And if we go back to the podcast we did prior to this, in and around those trigger points, it will get to a point where it could be cheaper to own it than it would be to rent it, which is the exact opposite of what it was in the middle of the pandemic, where it was the opposite. Yeah. And so it was very attractive for investors. So when we get to that point, and if someone or the majority or a lot of people have the capacity, whether it be via government stimulus, grants, good job savings, to then, I guess, move into ownership, that's going to create another set of issues in and around the Brisbane locality. But our philosophy around Brisbane is we're still bullish on it, not everywhere, very select areas, and in particular, if you can afford it, and this is down to one's own individual circumstances, the bigger the land component, the better you'll do.
All right. Conscious of time, let's quickly, we talk about these two markets all the time, so we can sort of just glaze over a little bit. Sydney, you like Sydney? Sydney, is it time for Sydney to shine? I know I've been out of the Sydney market for a little while. You guys haven't been buying out there, but what sort of stuff do you like in Sydney?
Look, I think Sydney's one of the most predictable markets personally. For me, it's always around affordability and flow of credit. So the more people can get them, more money that people can get their hands on, they're going to pay more for the asset. Yeah. I think Sydney, you could break into a couple of different markets, being the uber expensive, the well-paid white collar, and then the affordable corridors. And as with Brisbane, anything with warts on it is capitulating, literally. And not that we would buy that stuff anyway, but it's dropped, I'd say in some cases, over 30%. But it shouldn't have ever been at that price point to begin with. Well-located stock, well-presented stock is still selling. Anything that has cosmetic challenges is struggling because people don't have the serviceability nor the capital and the nervousness based around getting tradesmen or builders to then do that sort of capital works to the premises. We've seen auction clearance rates over the last couple of weeks be remarkably high for what is meant to be an Armageddon set of circumstances, I guess. But I think there's opportunity in Sydney, but it's going to come dressed up in disguise of hard work. And I'm talking about sort of stuff that is cosmetically challenged. That's my personal favourite flavour.
That's okay. If you want to have a crack at that, you can do well out of it, right?
I believe so.
Bring it up to like for like parity of other stuff in the areas. Like we've done that in Sydney a decade ago and done very, very well over it.
Very well.
It's similar sort of scenario in Melbourne, Steve.
Yeah, a bit of almost a mirror image. I think there's a little bit of distortion in the data in and around, we'll call it Melbourne and its surrounds, whilst their vacancy rates are very low. And we see on the news every day someone, I guess, talking about how they can't find rental accommodation. There's also, we're coming off a historic, I guess, low, for want of a better way to describe it, where the vacancy rate exploded and rents dropped during that COVID period. We've definitely seen a bounce back to over and above where it was prior to COVID. But the thing that's affecting Melbourne is traditionally their yields aren't very high based on the asset price. And in this higher interest rate environment, people are just a little tender to want to purchase. Now, that's a very general comment. Obviously, there are markets within markets and different elements of affordability. But I would suggest as the yields get better, it'll become more enticing for the person that wants to enter Melbourne. question is, with all of the states, is, where is my money going to work best for me as an investor? And that's the question you need to answer.
Yeah, cool. All right, done well there, mate. Thanks for your insights. Covered a lot of ground, literally.
Not a problem.
Always good to hear what's going on and how it's all working out. So all in all, there's some places around Australia worth considering to invest in.
Absolutely.
Yeah. Heard it here first. There you go, newsflash. Who would have thought a couple of blokes on a property podcast said, "Oh, yeah,"
would have said that? I know, right?
Property is a good asset. There's some places that are worth buying.
Well, look, as we've talked about before, we don't want to sound like those property guys, because we're certainly not, and it is up to the individual. But if you are a investor in its real sense, well, then there is some opportunity. And if you don't feel you can afford it, well, then sit on the sidelines.
There's
do
always
it. Always a market.
It's okay to wait.
Absolutely.
I wait all the time. I call it strategic patience. Very sensible strategy.
Some will call it procrastination and laziness on your behalf. But
I wouldn't say procrastinator. I'm not a procrastinator, but I wouldn't say lazy. It's just a refocus of my priorities, Steve. Maybe
okay,
what you call
we'll
it.
go with
anyway,
that one.
We're doing stuff at the moment. We've got to get you in and talk about the smart property investment portfolio as well. We've been talking about that for a little while. Well, I'm waiting for the interest rates to become terminal interest rates, so I just need to update the portfolio once, and then it gets better rather than worse.
Correct.
When I reset all the cash flow, a lot of that stuff's at P&I mortgages, right? So I'm getting hammered at the moment. So I'm resetting them back to interest only. Through a refinancing process, which is underway with the guys over at finny.com.au. So tune in for that. But Steve, I want you to come and talk about the properties, what they're doing, what should we do with them, how should we do with them, and all that other stuff. That's Steve Waters, Right Property Group. Thanks for your time, mate.
Pleasure as always.
Nice one. Remember to check out smartpropertyinvestment.com.au. Keep that feedback coming on whichever podcast player you're tuning into this on. Tim, get a real kick out of it. You want to follow us on social media, Smart Property HQ. And remember, smartpropertyinvestment.com.au. There's so much info going up on that every single day. Everything you need to know about property is probably there. See you again next time. Till then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.